Boris. I'm Bernard Hickey for the Kaka. This is my daily podcast and video, which goes out to paying subscribers through Substack and also into YouTube and around various platforms. I cover Aotearoa's political economy around the issues of housing, climate and poverty. Today, I wanted to talk about an article which appeared in the Sunday Star Times, but which is indicative of the way that many in the business community feel about the government's current economic strategy and the leadership of Prime Minister Christopher Luxon. Uh, in particular, I wanted to give you an idea of what people are saying about the strategy, why the strategy isn't working, and what the government might do in the coming months to try to get re-elected. Firstly, let's have a look at this front page of the Sunday Star Times yesterday, an article from Amelia Wade, which quotes multiple business leaders, some of which are named, others which aren't, saying that the government's economic strategy is not working. You remember this was going to be the year of growth, 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 according to the Prime Minister's State of the Nation address way back at the end of January, but that hasn't happened. We've seen the economy essentially slump back into a double dip recession where the June quarter is likely to show a fall in output of around 0.3%. And that, of course, is total output. It's even a greater fall per capita. And it shows that we're in an extended recession and that the government strategy, which is all about restricting government spending growth, restricting the size of the government's deficit, restricting the size of the government's borrowing, all with the purpose of lowering interest rates, will be all that needs to happen to try to get the economy going. It seems like a sensible enough theory. Certainly it's one that's taught in all the economic textbooks, that if the government pulls back during a time of inflation or has become too big, then when it pulls back, the private sector will step forward. So households will spend more, invest more, business sector will do that as well, with the trigger being lower interest rates. However, we've seen the official cash rate drop 225 basis points in the last year. Now, it's true that that hasn't immediately passed on to all homeowners because they are typically on fixed rates, but more than half of those high rates have now rolled over. And it still hasn't really gotten the economy going again. So why isn't it working? So let's quickly, though, circle back, as they say, to see what people in the business community are actually saying, just to make it clear, this isn't just the usual suspects who are complaining about the government. This is people who are normally supporters of the current government. So that's the Sunday Star Times front page. That is a fairly tough picture to put on the front page. That's something you hold back and you wait for a big opportunity, and the Sunday Star Times has decided that is the time. Okay, here's the full double page layout that came across on pages 6 and 7 of the Sunday Star Times. I'm not going to ask you to try to zoom in and read it for yourself. I'd suggest subscribing, which I do. But here's a few snippets of the comments that have come through. Firstly, Auckland's Heart of the City CEO, Viv Beck. So she represents a whole bunch of businesses in Auckland City, retailers, people in the tourism sector, basically everyone at the bottom of Queen Street along and back up to sort of Midtown. So it's a good chunk of, New Zealand's retail commercial sector. And if the economy is going well, typically those retailers are seeing plenty of money coming through. I was going to say the tills, but of course these days it's FPOS and through cards, which we can track, by the way. And this is what Viv Beck is saying about the current situation. In particular, the concern about the government's focus, apparently led by ACTA New Zealand First, on anti-woke type policies. So the most obvious one is changing the passport to remove Aotearoa from the passport. She says, I look at some of these things and think Rome is burning for some of our small businesses. Why are you talking about that? So there's a real concern. There's a lack of emphasis and really aggressive action to try to get the economy going, particularly in Auckland where unemployment is the highest. So Viv Beck says there's a frustration for businesses. There's no big picture plan. We can't expect the economy to turn around by itself. I think leadership is a key part of this. I really do, because they're not unsolvable problems. What she's talking about here is the government's apparently hands-off approach, saying all we need is lower interest rates. That will solve everything. Just wait. We're not going to do different things. We're not going to change our strategy, which is all driven by this desire to get the size of government back down to 30% of GDP and to keep government debt from rising too fast beyond where it is at the moment. Now, gross debt's about 40% of GDP. If you included the assets in the super fund and ACC, it's actually not very big at all. And certainly if you look at the interest costs, the net interest costs of the government, they're barely about $2 billion a year, which is nothing for a government which brings in $145 billion a year in revenue. Here's Simon Bridges. Again, you might recall I emphasised this last week, and he's saying again to the Sunday Star Times, we don't want to leave it to chance. A few more bad months after a few bad years isn't good enough. I think there should be an urgency in the government around intervention. So he's not mucking around here. And again, from a colleague of Christopher Luxon, in fact, one of his suggestions for finance minister when he was looking at that. And also, this one is from not just from Viv Beck, but this is actually from and this one is from Trish Sherson from Sherson Willis, which is a PR firm in Auckland, but also saying what's going on here. When you look at what has gone wrong, it's worth just firstly looking at the Reserve Bank. In 2021, it was one of the first to actually increase interest rates. And a lot of the critics of the Reserve Bank who say it was too loose for too long actually ignore the fact that it started hiking much earlier than others. Then it increased interest rates to significantly higher than many others. So that increased the pain, if you like. To give you an idea, the blue line there is the Reserve Bank of New Zealand. The pink line there is the Australian Reserve Bank. And you can see the Australians started later and they didn't hike as much. Now, they haven't cut as much now and they're above the New Zealand rate. But there's a good question here. Did the Reserve Bank tighten too much through 2022 in particular? And should it be cutting interest rates more now? Well, they're obviously going to cut later this week, but it's not going to turn things around too much. And the reason is we are in a balance sheet recession, one we haven't seen before, and it's compounded by a number of other factors. But let's first look at this. This is a chart from Cotality, former CoreLogic, showing the percentage of total sales or resales of property by homeowners in which they've had to take a loss is now up over 10%, in fact, nearly 11% in the June quarter from 9.3% in the March quarter. And you can see there going back to 1997, there was some periods in the late 90s when people were selling at losses, but that really dived away. Even through the period 2007 to 2010, it didn't get much above 10 to 15% of those people who were selling were actually taking a loss. Now that we're in a sustained downturn with 10 to 20% house price deflation, so prices as many as 20% below their peaks and actually more in some places, people are now staring down the barrel of a housing market which is not likely to regain its peaks for upwards of 10 years after hitting its peak in 2021. That's according to the current forecasts and the momentum in the housing market. Now, that's quite different to what we saw, for example, 2007, 8, 9, when by about 2010, 2011, we were seeing house prices rising again to fresh highs. That is different. Also, this time, there are restrictions on the banks. There are loan to value ratio restrictions, debt to income multiple controls, and of course, a foreign ban on foreign buyers of New Zealand homes. More on that in a minute. But you can get a sense now, this is according to the Reserve Bank's forecast, how long per capita before we get per capita GDP back to where it was from its peaks and before the recession, and how that compares with previous recessions in New Zealand's history. So for those old people, remember the 1967 to 69 wool bust. That was quite severe but short, only a couple of years, and we were back above water. The Asian financial crisis also didn't take long. Now, the global financial crisis was a substantial one. It actually took us over 4 years before we were back to above water in terms of per capita GDP, real GDP. This time around, we're looking at 6, 7 years. That's just for GDP, and it could be significantly longer for house prices. So for those people who are used to just holding on and waiting for house prices to rebound to hit new record highs, that's not happening. And that is making people feel a bit poorer. And when you feel a bit poorer, you tend not to spend, particularly if you're already up against it. Just to give you a sense of how much household net wealth has not risen. Now, this is total household net wealth. So this includes KiwiSaver and money in financial assets, but also the net value of people's homes, the ones they live in, and if they hold many, many homes, that as well. And I've included today's number of the day, which is the fall in the net value of New Zealand's homes between the peak in the end of 2021 and now. And it's $165 billion. Now, that still means people have net worth in their homes of $1.432 trillion. That's trillion with a T. So that's plenty, but it's down 165 billion. For a lot of people, the actual house sale is the moment where they turn that notional equity into real cash. And when you can't do that because you're not selling and no one's buying, that becomes a bit of an issue. Also, for household disposable income growth, you can see here during the problems with high inflation through 2022 and 2023, below the line means real incomes were falling. Disposable incomes were falling, and they are again now as well. So there's been an income hit, which has been an issue. The other thing to know, this strategy of lowering interest rates and hoping it all works out through a housing boom and business investment, we relied on in 1992, 2001 to 2019, 2016, and to an extent in 2020, although there was a whole bunch of things thrown at that. It wasn't just a matter of hoping for interest rates to fall. And that is a real issue now, because you can see here household credit growth. So this is mortgage lending. If you're going to cut interest rates, what you want is lots of new mortgage lending to boost the housing market. And we are not seeing that this time. You really need to get above 4%, that dotted line there, to really get some heat back into the market. You can see through most of the 1990s and 2000s, we had double-digit lending growth into the housing market. That's one way to get your economy going. As the government pulls back, the household sector steps forward, borrows money and buys each other's homes and builds some new homes and spends some money on boats and cars and double cab utes and the like. And then again, 2015, 16, and again, of course, 2021, 22. Now, what's different this time? Why are we not seeing mortgage lending taking off? Well, back before 2013, there were no LVRs. Back before 2019, there was no increase in capital requirements for the banks. Remember, whenever a bank makes a loan, let's say it lends someone $1 million, it has to put aside about $130,000 of its own money, put it aside as a reserve. That's something it's forced to do by the Reserve Bank, and it's common practice for banks and reasonably sensible. Didn't always used to be quite so much. When back before the global financial crisis, a lot of banks only put aside 40 or 50,000, not 160,000 for every $1 million in lending. And 2019, the Reserve Bank toughened those requirements again, and had been rolling out a series of capital requirement increases. So every time you do that, the banks are less able and willing to increase their lending quickly, because every time they do, they have to put some of their own money aside. And you may wonder also what's happening to all this money that's around. Remember, we had some tax cuts, and they weren't distributionally neutral tax cuts like the ones in 2010, 2011. How come that's not firing up the lending, firing up the economy? Why aren't all these people with extra money from their lower taxes from their rental properties, and for those people on higher incomes, why isn't it turning up in the economy? Well, turns out it's going into savings accounts. Just like we saw during the first and second COVID stimulus, when the owners of small businesses banked the wage subsidies into their personal bank accounts, and you can see that in household bank account data, when in those two periods, we were seeing annual increases of up to $17, $18 billion a year. Now, that has been rising again from 2020 three or so right through to now. And we're back up to near those record highs of about $16, $17 billion per year. And you may ask, hang on a minute, I thought we were in the middle of a cost of living crisis. How can anyone possibly put money into a term deposit account when they're in a cost of living crisis? Don't they need to spend all their money? Well, there's lots of people who do have to spend all their money, probably even more. If they're renting, they're in real trouble. If they're a young family with a big mortgage, they're in still quite a bit of trouble. But when you don't have a mortgage, when you have multiple properties, when you're older and you've got plenty of resources and you're not spending money because you don't need to, you don't have any kids around, you've already spent your money on your car, you don't need a new car, you're putting it aside. And actually, often what you're doing is repaying mortgages with the extra money that you get in. And the great irony, of course, is that for the last 4 years in particular, this talk about, people with mortgage costs increasing ignores the other side of the coin, which is people who are receiving extra money from term deposits. And up until about a year and a half ago, the net number was a net outflow from the household sector. So, there were more people with mortgages paying more money out than people got in from receiving interest on their term deposits. Well, the last year or so, that's turned positive again, i.e., there's a net positive going into the household sector from interest. So, and that's partly because the banks have become more reliant, or chosen to become more reliant on term deposits. Quite frankly, it's a bit cheaper than borrowing overseas. And that means that for those people, they've got plenty of money, but they're not spending it because they don't normally spend it. They can't spend it all. Their propensity to spend and invest is much lower. They're at a stage in their life where they're putting money aside. So all of the extra money from the tax cuts is not going into the economy. It's going into term deposit accounts. And they have risen a grand total since the election of $63 billion. And since COVID, they're up by $79 billion. So these are not small numbers. So what's the government going to do about this? If it's all about getting the housing market going again, and it is, because banks are not lending to businesses, it really is all about the housing market. What do? Well, you could hope the Reserve Bank loosens those LVR and DTI restrictions. There's currently no review of that ongoing, but you can expect there will be. Remember that the most recent appointment to the Reserve Bank board was of Grant Spencer, a former temporary governor, who during his time, one of the things he did do was loosen the LVRs. You've also got the last tranches of the capital increases to flow through from the 2019 capital review. And it's collectively an extra 3.5 percentage points of capital increase. Remember, we've done 3%, there's still 3.5% to go. That is currently under review. And by the end of the year, we'll have a clear review of whether or not the ones that are due to go through from the 1st of July 2026, and another one a year later at 2027, where they actually go through. And if you free up 3.5 percentage points of capital for every loan, so the banks now no longer have to plan for that, that makes them much more keen on lending. So we'll see that. Also, Christopher Luxon confirmed this morning that there's going to be a decision in cabinet on whether foreigners can buy homes, and it looks like the way to get around the opposition of Winston Peters, and he's already indicated that he's okay with this, is to allow the people who have applied for golden visas. Now, these are the ones where you put $5 million into a business or $10 million into government bonds, and then you get a golden visa. At the moment, you can't buy a house with that. So that's 5 million investment or 10 million investment. And it's quite likely those golden visa holders will now be able to buy a house, and that's going to make a golden visa more attractive and therefore put more foreign capital into the upper echelons of the housing market. That's one way to get things going. I'm Bernard Hickey. That was today's Daily Chorus for Monday, August the 18th. Ka kite anō.